welcome to the deep dive. Today, we're tackling something really interesting. Stable coins.
Right. Big topic.
Yeah. And you, our listener, you're keen to understand these, big financial innovations, but without getting totally bogged down in technical jargon.
And that's what we aim for. Cut through the noise.
Exactly. We're going to look at what these digital currencies, well, what they actually mean for the traditional banks we all use.
And to help us sort of navigate this, we've pulled together some great resources. We've got articles from PYMNTS and Alpha Point,
Okay.
which give a really good look at the current situation and maybe what's coming down the pike. And there's also a fascinating piece from Harvard Business Review.
Oh, HBR. What's their angle?
They take a kind of wider view, the potential for really fundamental change.
Okay, interesting. So our mission today, it's pretty straightforward but important, are stablecoins. A threat to banks, an opportunity, maybe both.
It's likely a bit of both.
And what does it all mean for, well, how we handle our money in the future? Okay, let's unpack this. Stablecoins and banks. It does feel like we're sort of on the edge of some big shifts.
That's really the core tension, isn't it? The
Yeah.
PYMNTS article really nailed this. On one hand, stablecoins could disrupt how people hold their money, their deposits. But then on the other hand, they might actually open up completely new ways for banks to innovate, find new roles.
One thing that really jumped out at me from that piece was this idea, they called it the deposit drain dilemma.
Right.
The worry being, if everyone starts keeping their cash in, like stablecoin digital wallets, banks lose that deposit base.
Yeah.
That's what they used to lend, right?
Exactly. That could have a pretty significant ripple effect through the economy.
So how serious is that risk? I mean, right now.
Well, it's a valid concern to think about, a potential large-scale shift.
Yeah.
But the PYMNTS piece also had insights from Adam Shapiro at Claros Group.
Ah, yes, I remember reading that.
And he offered a really important bit of perspective on where things stand today.
Right. He basically said that, in the U.S. anyway, stablecoins aren't really being used much for everyday payments. Not yet. That surprised me a bit.
Yeah, it's not like people are buying coffee with USDC on a mass scale.
So where are they being used then, primarily?
Mostly within the crypto trading world. They act as, a stable point in a volatile market.
Makes sense.
We also see them used, perhaps, by people outside the traditional banking system and maybe for cheaper international payments. But Shapiro made another key point.
Which was?
For most people, especially with large sums, the security and, frankly, the familiarity of a bank, that still carries a lot of weight compared to managing your own keys in a digital wallet.
Yeah, that's a really good point. Being your own bank entirely, that's a big mental leap and a big responsibility, too.
It really is.
But the PYMNTS article also mentioned that some banks aren't just, sitting on the sidelines watching.
No, definitely not. They're starting to dip their toes in.
Like who?
Well, a prime example is JP Morgan's JPM coin. Now, okay, it's mainly for their big institutional clients right now.
Right.
But it shows a major bank issuing its own dollar-backed stablecoin. And then you've got established players like BNY Mellon building out custody solutions for digital assets.
So holding crypto for clients, basically.
Exactly. These moves, they suggest banks are leaning towards integration, finding their place in the ecosystem rather than just, seeing it purely as a threat.
Okay. Before we dive deeper into how banks might fit in, let's just back up for a second, make sure we're all on the same page. For anyone new to this, what exactly is a stable coin? Alpha Point had a pretty clear definition.
Yeah, put simply, stablecoins are a specific type of cryptocurrency. Their main design goal is to maintain a stable value.
Unlike Bitcoin's wild swings.
Precisely. They do this by being linked or pegged to some other more stable asset. Usually that's a traditional currency like the US dollar.
So that's like a bridge.
Exactly, a bridge between crypto's potential and traditional finance's stability.
And Alpha Point mentioned these came about, around 2014, a bit after Bitcoin.
That's right. About 5 years after Bitcoin, their initial appeal was really about making crypto transactions smoother, cheaper.
Less volatility.
Less volatility, yes, but also potentially opening up financial services to more people globally.
Okay. And Alpha Point broke them down into different types, too. Can you give us a quick rundown?
Sure. The first and probably the most common type is fiat pegged.
Okay, like fiat currency.
Exactly. Linked directly to government currencies, US dollar, euro, etc. You probably heard of USDC, maybe Tether, USDT.
Yeah, those are the big ones.
Right. And usually these are issued by centralized companies that claim to hold, equivalent reserves of actual dollars or euros to back every digital coin out there.
Claim to hold. Is
But
there a debate there?
there has been, especially around Tether's reserves historically, transparency is key. And actually, PYM-NTS mentioned Tether is thinking about a US-only version,
Hmm.
probably driven by regulatory pressure.
Interesting. Okay, so fiat pegged. What's next?
Next up, commodity pegged. So instead of dollars or euros, these are tied to physical assets. Gold is the most common.
Like digital gold.
Pretty much. Think Tether Gold or Paycax Gold. Each token represents a specific amount of actual gold held in a vault somewhere.
Huh. So you get gold exposure, but maybe easier to trade.
Potentially, yes. More liquid than storing bars under your bed.
Fair point. Okay, and the last meme type.
That would be crypto-backed stablecoins. These are backed by reserves of other cryptocurrencies. Day, running on Ethereum, is a well-known example.
Wait, backing crypto with other crypto. Doesn't that sound a bit risky, given the volatility?
It can be, which is why they're usually over-collateralized,
Meaning
meaning you might need to lock up, say, $150 worth of Ether to mint $100 worth of Day. That extra cushion helps absorb price swings in the collateral, and they often rely heavily on smart contracts' automated code to maintain the price peg.
Okay, complex stuff. But even with these different methods, Alpha Point said they share some core traits, right?
No. Absolutely. The fundamental similarities are that pegging mechanism, whatever it is, aiming for stable value.
Right.
They all run on blockchain, offering transparency and security benefits.
Okay.
And, crucially, they exhibit much, much lower price volatility compared to something like Bitcoin or Ether.
Got it.
Step into the future of finance with Blockstar Dollar, the cutting-edge stablecoin from Blockstar, offering unparalleled stability and security in the digital currency world. It is built on a robust blockchain and ensures every transaction is protected with top-tier security, giving you peace of mind. It is uniquely backed by a 2-to-1 reserve. Blockstar Dollar guarantees enhanced stability and trust, giving you confidence in its consistent value. It seamlessly fits within the Blockstar ecosystem, granting easy access to our suite of innovative financial services. Whether you're a crypto pro or a newcomer, managing your assets is simple and straightforward with our user-friendly platform. Join the Blockstar revolution. Don't miss the chance to be part of a dynamic community transforming the financial landscape. Choose Blockstar Dollar for secure, stable, and seamless transactions. Visit www.blockstar.site to learn more and start your journey today.
Okay, so let's swing back to the banks then. Because it's not all doom and gloom or existential threats, is it? Both Alpha Point and PYM-NTS highlighted some real upsides.
Oh, definitely.
Yeah.
Banks have deep expertise and infrastructure that could be super valuable here. Think about custodianship.
Holding assets safely.
Exactly. They've done it for centuries with traditional assets.
Yeah.
Transferring that skill to digital assets, it's a natural fit. They can also be vital compliance partners.
Navigating all the rules.
Yes, the KYCML stuff, understanding regulations, that's their bread and butter. And they could even play a role in the underlying infrastructure, like being validators on blockchain networks.
Okay. Leveraging their strengths. That makes sense. They've got the trust factor for a lot of people, too. Yep. And Alpha Point mentioned totally new revenue streams.
Yeah, several possibilities there. Things like simple transaction fees for helping move stablecoins around or converting them.
Okay, straightforward enough.
Then there's the potential for asset tokenization. Imagine tokenizing a piece of real estate on a blockchain.
Whoa.
And settling the transaction almost instantly using stablecoins. Banks could facilitate that.
That would streamline things compared to today's processes. Major.
For sure. Banks could also issue their own stablecoins, like we mentioned with JPM Coin.
Right.
And potentially, though maybe further down the road and needing regulatory clarity, they could even participate in DeFi, decentralized finance activities like lending or staking using stablecoins.
Okay, lots of potential avenues. And what about just internal efficiencies for the banks themselves?
Alpha Point really emphasized the enhanced speed and efficiency. Blockchain settlement can be much faster than traditional systems without intermediaries.
Faster and cheaper, presumably.
That's the idea, leading directly to cost savings. Lower transaction fees, especially cross-border.
Ah, the cross-border point again. That seems key.
It's a big one. Plus, potentially lower fraud risks because of how blockchains work.
And Alpha Point also brought up financial inclusion, right? How did that work?
The idea is stablecoins could reach people who are currently unbanked just using a smartphone and the internet. No need for physical branches. That could bring millions, maybe billions into the formal financial system.
So, yeah, the opportunities are definitely compelling. But there are always buts. Both PYMNTS and Alpha Point were clear about the hurdles. What's the biggest one?
Oh, easily regulatory uncertainty. It came up again and again.
Yeah.
Both sources stressed we urgently need clearer rules, especially a federal framework in the U.S. Jonathan Levin from Chainalysis, quoted in PYMNTS, basically said big firms just can't comfortably jump in at scale without that clarity.
It's too risky otherwise, like building on shifting sand.
Exactly. You need to know the rules of the game before you can play properly.
And Alpha Point went into some specifics on what regulators are looking at.
Yes. Key things like liquidity, making sure issuers actually have the 1.1 reserves they claim.
Right, the backing needs to be real.
Transparency, forcing disclosure of those reserves, regular audits. There'll likely be approval processes to even issue a stablecoin, and of course, applying existing financial rules, KYC, AML.
Know your customer, anti-money laundering, standard stuff for banks.
Standard, but needs careful application in this new context.
And Europe's ahead on this. Alpha Point mentioned MiCA.
Yes. The EU's Markets and Crypto Assets Regulation, MiCA, it's seen as quite comprehensive. It covers reserve management, licensing, transparency rules like publishing white papers and reserve reports, and crucial consumer protections, like making sure customer funds are kept separate.
Segregated funds, yeah, that's important.
It could definitely serve as a model for other places, including the U.S., potentially.
Okay, so regulation is huge, but PYMNTS also mentioned internal roadblocks for banks, cultural and structural barriers.
This is really interesting. Banks are, by nature and necessity, heavily regulated. They tend to be risk-averse. Their operations can be incredibly complex, lots of legacy systems.
Right, not exactly known for being nimble startups.
Not typically, no. And that contrasts sharply with the often more agile, sometimes less regulated world of crypto and stablecoin players. Bridging that gap, changing that internal culture to be more adaptable, that's a massive challenge.
It's like turning a battleship versus a speedboat.
Good analogy.
No?
And then there's just plain old competition. Alpha Point noted that stablecoins inherently offer faster, cheaper payments.
So banks have to up their game.
Exactly. It puts direct pressure on them to improve their own payment systems, make them faster, cheaper just to stay competitive.
Okay, so we've looked at the dilemma, the basics, the opportunities, the big challenges. Let's zoom out now. The Harvard Business Review piece suggested this could be more than just tweaking the system. They talked about potentially huge systemic change.
They really did. HBR frames stablecoins as potentially interoperable and programmable money. That programmability part is key.
What does that mean, programmable money?
It means you could embed rules, conditions, logic directly into the money itself. Think automated payments that only execute if certain conditions are met, far beyond a simple standing order.
Wow, okay. That sounds different.
It is. And HBR went further, suggesting this could finally enable software to eat banking and financial services.
Whoa. Like the way software disrupted media or retail, they think finance is next.
Their argument is that while the internet digitized information everywhere else, the core infrastructure of moving value in finance hasn't been quite as disrupted yet. Stablecoins, being digital, programmable, efficient, could be the catalyst for that deeper change.
And they mentioned specific players that could be disrupted.
Yes, potentially displacing or forcing major changes in legacy payment networks, think SWIFT for international transfers, even Visa and MasterCard domestically.
Really, Visa and MasterCard.
That's the potential they raise, especially if stablecoin transactions become significantly cheaper and faster. They also talked about it accelerating the unbundling of banks. Instead of one bank doing everything, you get more specialized players offering just one-piece payments, lending, custody perhaps built on these new rails.
A real shakeup then. And HBR even looked beyond finance. Some global stuff.
Yeah, they pointed out stablecoins, especially USD-pegged ones, could increase access to dollars in countries where it's difficult to get them, or where local currencies are unstable, even in places under sanctions.
That has big geopolitical implications.
Potentially huge ones, yeah. Monetary policy implications, too.
So, bringing this all together, it really feels like the question for banks isn't if stablecoins matter, but how they're going to adapt. It's about integration, isn't it?
I think that's exactly right. As PYMNTS hinted, it's going to require real adaptability, embracing the tech, shifting the culture a bit towards understanding DeFi, and fundamentally being willing to reimagine what role a bank plays in this new landscape.
Okay, so we've definitely taken a deep dive here into stablecoins, looked at it from different angles thanks to PYMNTS, Alpha Point, and HBR.
Yeah.
Hopefully for you, our listener, this complex area feels a bit clearer now.
Yeah, it's certainly not a simple threat or opportunity story. It's much more complex. It's about transformation.
It seems the future is likely, well, hybrid. Traditional finance and these new digital assets coexisting, interacting.
In ways we're probably only just starting to figure out.
Right. And knowing you appreciate getting up to speed efficiently, here's a final thought for you to chew on.
Yeah.
Given this potential for stablecoins to reshape not just payments, but the whole structure of finance, what parts of traditional banking do you think are most likely to be transformed or maybe even disrupted in the coming years?
And maybe flip that around. What totally new roles or services might pop up for financial institutions that we haven't even thought of yet?
Exactly. It's a fascinating space to watch. We really hope this deep dive gave you some valuable insights beyond the daily headlines. Thanks for joining us.